Righto, buddy miners. Welcome to another yarn brought to you by the best resource in bloody drill hole survey instrumentation, Axis Mining Technology, the trusted advisor. And we've got one of the... Look, I'm just going to put him out there as one of the best bloody resource fund managers going around. Dave Franklyn, Argonaut, co-head of Argonaut Funds Management. Mate, you will not get an intro like that ever. You have to pay for that shit usually to get titled like that. How are you, Copper?
I'm good, Matty, and hi, Ali, and JD. Thanks for having me on today.
Great to have you back.
Yeah. You're obviously still making money if you're still coming on. So
well, that's right.
People don't come on
that's
if they're losing money with found.
Yeah, what I find is there's times in the market where you're making money, and there's times in the market where you just try not to lose money. And the last year has been a bit like that, right? It's just hanging in there.
Very
Awesome stuff.
Very good, mate. Throw us me iPad GC because I will 100% go rogue as anything if I've got no guide. Yes. JD, tuning in from over east. Yeah, east
Mate,
of us.
I couldn't miss it. And I was actually, I was excited. I listened back to the chat we did almost a year ago now, Dave, and it was, interesting to reflect back on the way of the world back then and how things are now. So, maybe keen to start with just what your sort of sentiment check was at Diggers. We bumped into each other a couple of weeks ago there now, and that's always a good place to get a feel for the market as it kind of relates to what we follow in commodities. What were you kind of thinking?
What a week, eh, Dave?
It was a great week, as it always is. But, I think Diggers this year was what it used to be. It was all about gold. And I think if you look at where commodities gone over the last year, everything's, a lot of the base metals have been tough. Lithium, I'm sure we'll talk about today, has been catastrophic. And but gold's up 20%, and particularly the gold producers have been up very strongly. And perhaps if there's one disconnect is that the smaller golds really haven't moved. But, Diggers, all about gold, and a lot of the management there strutting around and reclaiming their position at the top of the heap.
Feeling pretty good about themselves, hey?
Yeah.
Did you find I think I repeating myself a bit here, but the common theme I felt from Diggers, there wasn't many high conviction longs. Like people were like, right, what's the bet at the moment? What's the bet? And like there wasn't like a real, because things like Spartan have already had the run, and people are like, well, we're still long, but it's like there wasn't
what's
that really. What's the next big thing?
Well, I think you're right, and that's in the gold sector, but it's also really across the resources space. So what you tend to see is an emerging opportunity. Everyone jumps on it, and it re-rates pretty quickly. But I think you're right. It's it's a difficult market to find those special stories.
Anything other than gold that was sort of your fair? What gets a silver medal for Diggers? What was getting moaned about a bit? Yeah,
look, I thought some of the, I thought the Pilbara presentation and Patriot were good presentations. And, I think what's interesting about lithium is where the spodumene price is in particular suggests there's not a whole lot of downside. I think in the equities perhaps there can be, but as a market, it's getting interesting because it's way into the cost curve. And, I think as a resource sector investor, what you're looking for is to buy the really high quality assets at a good price, and it's these kind of markets where those opportunities emerge. So, that's the exciting thing.
Yeah, and was there much chat around the fundies with, just after Diggers, we obviously seen the Pilbara Latin deal.
Yeah.
Prior to that, what was the talk about getting positions in lithium? Is everyone thinking...
stay away?
I think we've learned about lithium. You can't predict when the pain's going to stop because it could keep going.
Yeah.
Well, good. But are people starting to, was there a bit of a vibe they're starting to think,
well,
how much lower can you go?
Yeah, I think so. And I think lithium, but also across other commodities. I mean, you look at something like Metals Acquisition Corp, they're obviously pretty open about the wanting to add assets. You look at Beach Energy, which we might touch on. They see Brett Wood's coming in there. It's all about growing the asset base and looking adding assets. So I think we're entering a phase really across the resource landscape where acquisitions is often an easier way to grow your business rather than developing new ore bodies. So.
I think Dave probably on this theme and sort of touching on a quote that really stood out from our last chat and arguably probably resonates very strongly today is observe and react rather than predict. I mean, it's been such a rocky ride for resources in the last year. What have been sort of your key observations you're making at a macro level and how you sort of deliver on that observe and react rather than predict in a portfolio sense?
Yeah. So really what it comes down to is how do you deal with volatile and uncertain markets, right? So, if I to put it into context and really from a macro view, if you look at what's happened over the last year, you go, well, in the Western world, interest rates have been increasing, economies have been slowing, question mark whether it's going to be a hard landing or a soft landing. You've got China, really lackluster economic performance. You've got, conflicts in numerous places around the world. And most of that is at face value not very good for resources. So, you've got two approaches. One is you just go, I'm going to make a call, right? Things are going to improve, the market's going to go up, or things are going to deteriorate, the market's going to go down. And I'm going to switch into cash and sit there. And, if you think it's going to go down, you switch into cash. If you think the market's going up, then you get fully invested. The risk with that is, markets often don't move how you expect that they will move, right? So the way we take it is we say, well, let's not predict, but let's just prepare for the eventuality. So given those factors that I've just said, the way we adjust our portfolio is to say, well, we probably want to have some flexibility. So we don't want to be in small caps. Typically, we want to be in big caps. So at the end of July, for example, I think we had 70% of the portfolio in companies with a market cap above $1 billion, which, and 70% in producers rather than developers. And I think, almost 90% of the underlying projects in the portfolio were in either Australia or North America, right? So you kind of firstly say, well, let's minimise risk as best we can, but we stay invested, right? But the benefit of being in those bigger companies is if the market does correct, either you get the benefit of being better quality because they fall less and recover first, but also if you then make the decision where you convert into cash, you can. So a really good example was, that's where we were at the end of July. The first week of August, as you'd recall, was pretty scary. On the Friday night, New York market fell. And the positive was, going into Monday, I'm going, I know exactly what we're going to do. Our portfolio is in reasonable shape. There's always stuff. You never get it 100% right. But, our portfolio is in good shape. I think what I'll do on Monday before the US market opens on Monday night is we'll sell a bit more, increase our cash, so it went above 25%, because it looked like it could have been one of those events where you get a bigger sell-off. Now, that didn't eventuate, so what it means is during that week we could start to invest our cash. We really didn't take any negative downside from that, and we move forward.
Yeah, I mean, you've also got the ability in the fund to an extent to go short. Is that something you've tapped into in the past year? We haven't. I know everyone you have on here says they don't.
Has.
Yeah. but what I would highlight, JD, is how you structure your fund when you first set it up is also really critical, right? So things like can you short is important, but can you invest in big caps as well as small caps? Can you invest internationally? What percentage of cash can you hold? Can you short? Can you buy mining services companies as well as resource companies? Because what you're looking for is areas where you can hide when the market's under pressure, but also, as broad a range of stock picking opportunities as possible. So that's important.
It's a tough one. It'd be a tough one to surmise, but how do you, in terms of quick pros and cons of a majority long, preserving cash when you need it and buying low versus long short, because long short, stocks will go up or down or stay the same. What's the trade off of preserving the cash compared to activating a short position?
Yeah, look, I mean,
is it a risk? It's a
combination of things. Is one, I look at the groups that do short and where you can get some information on them, really across the market, and it's difficult often to see that over the course of a year, they actually create value through that process, right? The resource market is also pretty small, and not a large number of companies that are really liquid. So, you need liquidity to do it effectively. So the view we've taken to date is we haven't done it, and we probably won't do it, but we just like to have that capacity to do it if things change.
Is there much capacity for it? But when you've got funds that have been long short for a long time, and they're probably in terms of the prime broker relationships, and then now if say the Argonaut Resource Fund says, right, we're going to start amping up our short positions, do you sort of have to get in line to get into the pool a bit? Or
I think you've got to have those relationships, and it comes down to the size and the frequency and the quantity that you're doing. But as I said, we've stayed clear of that to this point.
Very interesting.
Yeah,
you really tap into the ability to go to cash, and that margin that you have there is notably bigger than some other funds. I mean, you mentioned up to 25%. The numbers I looked at, just skimming through this morning, I think was 17%, where you're kind of currently at. The time you last reported. That's really the safe haven, as I see it for you.
JD knows everything about you, Dave. Bloody nothing gets past the big fella.
That's right.
Blood type and your tax file number too.
That's right. So we can actually go to 30% cash, and we tried. The risk that you have when you have the ability to go to 30% cash is you go too cautious and you sit on high levels of cash for a long period of time, right? So you've got to keep telling yourself, I'm in this business to invest, I've got to invest, which we try and do. So we use the higher levels, say above, particularly above 20%, but even really above 15%, is when you got concerns about the market. And we typically won't hold large amounts of cash for a long period of time. It's really just when you think there's an uncertain event or the market's there's issues there, then we'll hold off. But we think it's an important part, and it kind of goes to to the shorting. We'd prefer to hold cash rather than short at this point. Yeah.
Dave, so the way you think about your portfolio is sort of structuring into it the two themes of one being energy transition and the other geopolitical risk. You sort of talked to a bit of sort of what's changed from last year to this year. I mean, arguably, I think probably the interesting ones to us there, you could probably add to geopolitical risk is permitting risk in Australia.
Just Australia.
In light of what's happened in very recent history, and addressing baseload power and what the future energy mix could look like globally, and perhaps in Australia has been quite a political and controversial topic as well.
Yeah.
How have you found that's impacted the portfolio more broadly, like with those themes? Is it sort of swung to one theme more than another?
Yeah,
last year?
What I've found interesting, like we kicked off the fund in January 2020, and at that time we kind of sort of outlined here the sort of key resilient themes, energy transition, geopolitical risk, and and still doing our monthly presentations. The themes are the same. So, if you take energy transition, I think the big change has been really up until probably a year ago. People talked about energy transition, but they were really talking about electric vehicles and the EV market, and and the rollout of that globally.
That's true. It was just cars, solar panels, and wind turbines, wasn't it?
Yeah, exactly, and renewable power. Whereas I think now it's going, transport is 15% of global greenhouse gas emissions, and whereas power and industry, and it's really the fossil fuels used in powering industry is probably 55 to 60%.
I suppose they were thinking, but originally that there's the renewables were going to be the baseload power.
Well, that's right.
Exactly what the Australian government thought. So that's why nuclear wasn't even getting a talk about.
Yeah. So so I think where we're at now is there's a much, which I think is healthy, is there's a much greater understanding that we need to address the baseload issue, right? And renewables is part of that. Really, I think where that's fallen down from a baseload perspective is battery storage, which really technology hasn't sort of driven that forward. But then you're right. Then it's things like nuclear power, But also I think gas has come back as a transitionary fuel, and people understanding that's going to be necessary either to replace coal, thermal coal, or to support renewables. So I think it's it's positive there.
What have you sort of noticed, just swerving back to the geopolitical kind of front, and gold is the key part, and I find it fascinating. You got oil and gas as well in there. I mean, it's a bit sort of grandiose to talk about everything going on in the Middle East, but how do you kind of play that when you're talking about oil and gas and you're picking names like Karoon in your top 5? Are you thinking about any of that stuff, or are you just purely focused on the bottom up fundamentals of the names that you're holding?
Yeah, it's a combination. The way I often describe what we do, it's top down meets bottom up. So, what's happening at the commodity level and what's happening at the micro company level. Something like Karoon's a good example of that. Well, we're going, if you look at what's happened in, Russia, Ukraine, you look at what's happening in the Middle East, we particularly like oil. We think prices will be supported there. Karoon has obviously had a few disappointments in the market. We think it's coming through that. On a free cash flow generation perspective, it looks really good. So there's kind of commodity is where we want to be, and and from a value perspective, it also sort of stacks up.
Do you think it's now more so difficult to be high conviction in this market? That's something sort of we spoke at length in our last chat, and I noticed in your monthly report from about a year ago, your top 5 comprised almost just over 50% of your portfolio. Now it's down to about a third, which is arguably a lot more than most fund managers still anyway. But how do you manage that, or you still take the view on otherwise you compromise on quality? That was another.
Yeah, well, I think that's right. In that, again, it comes back to the resource sector is actually relatively small, and so when you find a good idea, you want to be able to back it. So that's right. Our top 5, I think, are 34% of the portfolio, and our top 10 are about just under 60%, 55 or 60%. Yeah, right. So what we're seeing in the market now, and I think Maddie, we were talking about this earlier, that it's just kind of hard to find those really compelling opportunities. So we tend to have a bigger number of more moderate holdings, but as you're saying, relative to what other funds might do, our relative, modest holdings are still 4 to 6%, right? So
compelling. No, I'll use an example. Genesis. Do you hold Genesis?
We don't at the moment. We've held it in the past. So mate, the way that we sort of manage the portfolio is we say we have a universe of investable companies that we like and we want to own, right? And then it's really does the macro situation favour that, and does it look good enough value? So Genesis, we love what they're doing. I mean, obviously Raleigh has done a great job in pulling the Genesis business together, and now it's really in the execution mode. But we think in the gold space, perhaps there's better value at the moment.
Yeah, and so the reason I brought that up as an example, and probably in the year since we spoke to you last, like when I was talking about Ulysses, thinking like, right, I think it was a 5 gram resource. I forget what the reserve grade is, but I'm like, mining 4 gram dirt and it's flat, and once you get the recovery, it's like hard work and all this. But the gold price has gone up so much, and you look at what's out there, it's like far out. If you're pulling out 3 to 4 gram dirt from a underground, even if it's a bit difficult, it's like, well, that's actually good these days. Yeah. So like what we considered was like compelling opportunities, and like just based on looking at grades, like tons and grade, like it's just changed so much in a year. Like a bloody 1.2 gram open pit. That's like fucking geez, give it to us any day. Yeah. Wouldn't have even pissed on it 10 years ago.
Yeah. Well, I mean, it'd be interesting to look back 12 months ago and what the expectations were about all-in sustaining costs, which is the other side of what you're talking about. It was probably 1,1600, maybe slightly higher, but probably not a lot. Whereas now, 2,000 is kind of not unusual, and some are more than that. So
no, if you're 2,000 and unhedged, like you think
you're a genius.
Yeah, exactly.
You think you should be still making maybe $800 to $1,000 on top all in. Like you're frigging laughing.
Exactly. Yeah. exactly.
I'm a ding 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 on Genesis.
Oh,
also,
ding
by
ding
the
dings.
way.
Well, just rip the ding ding dings. Oh, you're a ding ding
And
ding on the fund.
I am a ding 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 on the fund as well.
Good. That's some responsible investing, GC. Like you're not punting there. Like well done, mate.
Thanks.
A ding 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 on Karoon on my part too.
Right.
While we're on gold, I think we should just dive a bit deeper and round out how you kind of play it. So obviously we're talking about a producer there.
Yeah.
How do you talk about getting leverage? Obviously everyone's raging about the gold price in Aussie dollar terms over 3,700 and all that. And then people start to quickly look down the curve, what's in the developer space, what's in the explorer space, and see where they can really find value still. What are you seeing out there?
Yeah, look, so to put it in context, in our fund, we typically have between 10 and 15% exposure to gold, and it's probably just tipping up to, it's about 12 or 13% at the moment.
Is that 10 or 15% of what's invested, or the total fund, including the cash?
Yeah, total portfolio, including the cash.
Yeah.
Which is probably one of the bigger exposures we've got to individual commodities, as you'd expect given the way it's gone. But our exposure is, West Gold, Northern Star, and De Grey we've owned until recently, and we'll probably roll into another producer. So we haven't really gone down. I mean, we've looked at we've been an investor in Spartan during the year for a period of time. I think some of the emerging projects like Catalyst and Ora Banda have done really well. But we've at the moment we're sitting in the bigger producers.
How do you look at Capricorn? Like it's one of them. Like you look at how its performance recently. It's always been traded at a high multiple. But it keeps on going up. So it's like and the potential plans to expand Karlawinda. Like everyone says, oh look, it's going to get deeper and might get deeper and higher strip and get a bit more difficult. Oh, well, you can just expand the plant and maybe lower the cost and offset that then with Mount Gibson coming on. But it's just one of them ones that it really never gets talked about because everyone's like, oh, it trades on such a high multiple. But it's like possibly one of the safer bets.
Well, I agree
out
with you.
there.
I agree. Capricorn is the gold company I want to own, but I don't own it right now. And the reason that I don't own it is I do have some concerns about the permitting of Mount Gibson and how quickly that'll come through and potentially a delay. But if you look at it and maybe comparing it a bit with Genesis, is you go, well, today it's producing 115,000 ounces. You crank up Karlawinda a bit, that maybe gets it close to 150, and then you bring on Mount Gibson, then you're at 300,000 ounces or slightly more. Stay within a three-year time frame, something like that. But the point of difference is going to be their costs are going to be low and their free cash generation is going to be really significant. And I think that that combination is really compelling. I think. When you look at it on multiples at the moment, the market's factoring in a value for Mount Gibson that doesn't flow through in earnings, right? So you got to be careful on that. But so I like it. And I'm just looking for an opportunity to buy it. And obviously, management team are as good as going around.
Yeah.
How do you think about paying up for management? So they're obviously the name, and you've also mentioned Raleigh develops one of your biggest holdings as well. Yeah. I mean, but Capricorn is at $6 last time I looked. So you are really paying up for it. Can you talk a bit to that?
Well, I think the benefit of backing people that have a strong track record of delivery is twofold. One is they attract good people into the business, and I think we've seen that with Develop, but also with Capricorn and Genesis. But you also know that if something unusual happens, they have an ability to raise capital, right? So in the resource space, your risk is you're developing an asset, you're not generating an income stream, and something goes wrong, and you're struggling. Whereas that the market's always going to support those guys. So I think that's a benefit. So I think Genesis is a good example when Raleigh stepped in and implemented his plan, the market immediately applied a premium there. Capricorn's the same, Develop's the same. So I think there is value there. You got to be careful because that premium can be eroded if things change. But but backing good people, I think, is a good strategy.
We have the same effect when we have Ali on an episode. Like we get a view premium. We just got to have her mug on there, and it just
the
goes up.
LGC premium.
The LGC premium. Same sort of thing.
Sorry to interrupt you. Probably the other guy that I'll mention in that group is Chris Ellison from MinRes, right? And obviously MinRes is under pressure, and it's one of those companies which is in our investable universe. There's been times where where we've owned it, and but then it got a bit expensive. But now you can kind of see there's
$43, mate.
There's an emerging opportunity. Whether it's quite now, I'm not sure. But from a medium term perspective, it's a stock that you want to own because you'd back him on what he's done.
Yeah. I'll ding myself on Mins and develop there.
Geez, you own everything, Jason.
No, I just spread myself too thinly. That's the problem. But I guess the interesting thing with Chris, he is very much in that sort of universe as well about ability to, execute and get things done, raise capital, all that. But how much lower can Mins go?
Well, exactly.
Just, where does it sort of stop?
Yeah. Well, you look at the business mix. You've got lithium. Again, he's got some good assets there, but the lithium, spodumene price at $800 a ton US means no one's really making any money, right? So the market's not applying a whole lot of value to that asset, notwithstanding, I'm of the view that it can't really be sustained at these levels and that prices will move higher over the next year or two. So the market's discounted for that. On the iron ore side, you've had iron ore prices come back from, 120, 130 back to just under 100. So again, that's not helping him as he's bringing on, his new iron ore project. So you can see that it's really at the commodity level that he's being impacted. But, looking forward, you'd go spodumene prices are probably near their low. Iron ore prices, I don't think have a lot of downside beyond $90 a tonne. So there's an emerging opportunity there.
Actually, while we sort of touched on Develop as well, we noticed that that's of your sort of top 5 holdings. That's the one that sort of remained pretty consistent between, last year and this year. But Develop has come off 25-30% in that year too. So why do you feel that it's important to stay high conviction in someone like Develop?
Yeah, well, so between then and now we've kind of been in and out a few times. Because you're right, it's one of those stocks where probably more than other ones we own. There was a backfilling of actual earnings and and operations. It was a relatively early stage. So when it ran up particularly strongly, we took some profits and then we sort of re-entered. Okay. I think obviously what's good about it now, I think if you look at what they've achieved over the last year, I think they've made a lot of progress on their mining service business, and really the outlook for that's only improving with, for example, Bellevue and what's happening there, and other operations. And I think that on Woodlawn, that's also looking as a pretty good operation. Then obviously Trafigura also signing up for some offtake. So
it didn't get really much activity after that. That was probably a pretty key announcement with that. That off financing deal. Yeah. But what do you think the investors are waiting for? Like, what do you think is going to be the? Is it the FID is going to be sort of the?
Well, I mean, I think so. I think people are now saying it's there, it's ready to go. There's no really hindrance. It's just like to see copper prices a bit higher and then press the button. So
it's set up beautifully in terms of all developed ahead and at ore, and I think they said they got about 2 years worth of production already developed. So in terms of
it's a good
execution,
they obviously got to do up the mill and everything to get it going. But like in terms of a mining side, like should we just frigging flowing out once they do pull the trigger. So that's just de-risk that so much.
Yeah. I think you're right. And getting back to the question, why isn't the market reacting? I think the market is very earnings focused and it's very fundamental focused, and Develop's kind of still, we've got a base business here, but it's what we're going to do in the future. So notwithstanding the funding is locked away now. So I think it'll come as market sentiment improves.
Yeah. I think it's shaping up similar. not really, because I suppose in the Northern Star journey, like Paulson's ticked along for ages, and then it was like, the Barrick assets, Newmont assets, bloody bang, 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 and then it was flying. So it's sort of, Woodlawn's sitting there. I know it's not getting mined yet, but it's like when there may be a flurry of activity inorganically that might come for them, and then it'll just start rolling. I think he's proved probably, except for Pioneer Dome, proved like a lot of discipline in the Northern Star days, and when he picked up a lot of things fucking pretty cheap, and look at they're still mining those assets today.
Yeah, exactly. Yeah, so, Pioneer Dome I think was a good idea at the time, but
look, it might be a good idea in the future too. It's just not a good idea at the moment. At the moment, but it's only going to take a friggin' we're not even, as I said, at the start of the year when lithium absolutely started to shit itself, everyone's like, look, this could be a 6 to 18 month sort of downturn. We're 8 months in. So we're still early in what could potentially be a soft period for it. So no one bloody knows where anything's going. We're all guessing.
Absolutely.
Some people guess better than others.
Where do you think copper has to kind of hold above for them to make the call on Woodlawn?
I think it's probably, somewhere between $4 and $4.50, a pound, probably $4.25, that kind of level.
Because and that'd be that's pretty heavily contingent, I'd say, because he wants to guarantee the price is bloody high. Because I think as soon as they start, is it FID or producing? I think the next payment to the
that's right. Yeah.
Not the administrators gets activated.
Yeah.
So I think they obviously want the price to be bloody high so they don't get really hamstrung by that.
Yeah.
It's 30 million or something.
That's right. I mean, I think
off the top of my head.
I think what you want to see is some certainty about the sustainability of copper prices. So rather than just a tick up, and that probably relates to what's happening in China and what's happening with the global economy. But with interest rates near their peak and likely to come down, particularly in the US, you can see better times, moving into next year.
On the copper front, I mean, there's been heaps of news since we spoke. Big end of town, BHP. They obviously went after Anglo. Then they actually signed up a deal with Philo as well.
Yeah.
I know. I think we spoke about Mac at the time, Sandfire, these sorts of names, Firefly. Where else are you kind of looking around? And you spoke about your ability to look overseas before as well. Is that something you're tapping into for copper?
Look, we've looked, and there's, we owned Tech for a little while, which was partly, on the shift to being a more pure copper group. So we've owned Capstone, but often there's no easy way to play copper globally because you've either got typically you've got a big exposure to South America, or you've got an exposure to somewhere like, the DRC. So, we kept coming back to, Mac and Sandfire. We can own BHP and typically we don't buy BHP for copper exposure. It's really for iron ore, as you'd expect, 70% of earnings, but does give you the ability to get some exposure.
Do you find it strange that like a developer like Firefly is actually outperforming producers? Or is that more of a comment on the asset quality? Or
it's more an exploration. It's an exploration play, really.
Yeah, and that's quite unusual because we've seen sort of quite the opposite in gold, right?
Yeah. I mean, you're right. The only benefit is, if you're in a commodity where you've got a positive long-term view, but the short-term view is struggling, what that means, if you're a producer, you might not be making money, and so people don't want to be there. But if you've got a quality asset that's going to be ideally producing a couple of years in the future, then that can be a better way to play it because everyone's not looking at the earnings and how that's falling in the short term.
Matty, I think it's time to talk uranium.
It's you time.
So,
what a bloody Friday! Friday's a big day. Oh, everyone's like, it's just fucking imagine the calendars are on people's fridge that have just got Kazatomprom announcement. Kazatomprom announcement. It's going to be an interesting one, that.
Last time
how much were you in uranium much, Dave?
Yeah, so we've probably got around 10% of the portfolio in uranium. We
last time we talked, how much were you much in it then?
We'd owned Next Gen really for years. So I think last year that was probably the only one we owned. We've kind of rolled through that now, and we own Denison and Fission. And actually, we've just bought Yellowcake, which is more of the physical, because the discount to NTA has actually opened up quite a lot.
Yeah, what's that one? Well, I know because Sput's gone from friggin' 9 to 15% around that range, and that's what Yellowcake was always 15%.
Or more, it's about 20, 25. So exactly. So we're there, and I think medium term, we're positive on it. We think prices will go up, and there'll be some opportunity, and there's a relatively small number of decent sized uranium stocks. So we think we need exposure there. Yeah.
What can we kind of read into you? With Next Gen, your biggest holding this time last year to now no longer. What is that? A valuation? Was that a management? Was that a permitting timelines type of thing? Why'd you sell out?
It's good bet because it's gone down shitloads.
Yeah, well, no, and we probably, we didn't sell at the top, but it's really a relative valuation, right? So Denison's also in the Athabasca Basin. Fission we own, which is, as you know, is next door.
Right, yeah.
So we just thought there's better value in those names. Obviously, Next Gen's done a capital raise. Ultimately, when it gets to approval, there'll be another big capital raise you'd expect. I think you guys have commented on some of the management decisions, which I think the market has also made it has impacted on the market. But our view is we're looking at our relative value and hence switching to Denison and Fission.
We talked about yesterday that ATHA deal. Like ATHA's been picking up bloody ground ever. It's just the bit of exploration mania in the Athabasca Basin starting to happen. Like when that sort of commences, whether it's like over there and or in Australia or all over the world, similar to what was happening with lithium.
Yeah.
How do you approach that side of things? Is it like too risky, too volatile, or like do you start dabbling in that sort of stuff?
Look, I think in uranium you need to be in the bigger players because what you've seen is to get a project through approvals is difficult, and then the whole build out takes a long period of time. So, and I guess more generally, what you've got is globally there's actually a lot of uranium out there. It's just the permitting and approvals and build process that takes so long. So, my view is that the best time to be in uranium is really probably in the next couple of years, maybe next 3 to 5 years, where supply is still constrained and demand is starting to take off as nuclear builds its position as baseload power source.
Yeah, speaking to that sort of permitting and approvals thing, I mean, and not to get too political about it, but how do you see uranium, nuclear more broadly playing out in the Australian landscape and perhaps becoming some sort of part of our energy mix, or even just having the ability to mine it and export it in Western Australia? How do you see that?
Yeah, I mean, I think Australia has one of the biggest uranium resources globally, right? And
a lot of obviously with Jabiluka and Olympic dams, a big contributor to that. Yeah.
So I think in this day and age where we're moving away from fossil fuels, it seems logical to be able to access that and sell it internationally, and also develop an industry in Australia. So I'm supportive of that, but I also think it's part of the mix, right? I think it should account for part of the solution. I think there's obviously scope for renewables and there's scope for gas as all supporting sources.
What do you think Kazatomprom's going to say on Friday? What do you think's going to, and because when you mate, when you're the stewards of other people's capital and you're betting on uranium, that's like going into Friday and you got the weekend, like whether people are long or short, what comes out Monday in the market, like it's a pretty volatile play based on one company speaking. What do you think's going to happen?
Yeah, look. My view is, if you look at what the analysts are saying, they're saying production's going to be at one level, but their target and what they put out will be at a slightly higher level.
Yeah.
And then they won't achieve that target, right?
So that's irrelevant at the moment.
I think there'll be a downgrade just because of what was out there previously was at the high end. It probably won't be as big a downgrade as the market's expecting. But I think as we get through the next 12 months and, into 25, I think ultimately the outcome of production will be below the target and probably more in line with where the market's at. So you'd suggest also from Kazatomprom's perspective that having the market react by forcing up prices is probably a good thing. So,
and I think to understand Kazatomprom as a stock is something that people have to do in terms of if they piss off the stock market, they don't, not saying they don't care, but 75% of the mines are owned by the Kazakhstan state.
Yeah.
What you see on the stock market is the 25% free float.
Yeah.
So who are they going to look after the most? They're going to look after the state. They're going to do whatever is in the best interest of the state. And if they have to answer to the share market because for the other 25%, they'll be like, it's all good. We're looking after the big daddy. Yeah. And that's like, I'm been sort of trying to wrap my head around like what's the best for that side. And the mineral tax is probably the example. The lifted rates for the MET over there is the best. You would think the best for Kazakhstan to make more money. Yeah. Maybe at the expense of Kazatomprom, the stock.
And there's also the sulfuric acid issue, which which is another constraint. So I think it's fascinating. I think, and it would be interesting to see how that all plays out. And we saw with Cameco's result recently. The market took that negatively. So it's one of those markets where you've got a small number of companies that dominate production and what they do has a big impact.
Yeah, and the fact that like if they do say a lift, say even if they do promise a lift in pounds for 2025, it's all going to Russia anyway because it's got all that Budenovskoy 6 and 7. Yeah. I think for the first 2 or 3 years that's all goes to Russia anyway. Yeah. So it's completely debottlenecked from the Western world. And even China to a degree. So and China just announced another bloody 6 reactors planned to be built. So it's a fascinating space.
And I think that's really the point, isn't it? Is you look at the demand outlook in the next few years in particular, it's very strong and supply is going to struggle to keep up. So I think that's really the opportunity.
Yeah, very good. Mate, I've got a couple of these are a bit random. I don't know if you're into mining services, but not telling you how to run the fund, but there might be some IPO opportunities coming up next year. And I'm thinking maybe MMS and Silverstone if they actually float. And Dave, look, we've got a direct line if you do want to get a bit of seed, I think, because in terms of two sensational businesses that I'm predicting might go on the market next year. GC, like you'd take a bit of skin.
Oh, bit of skin. I mean, just like I want to be the lead manager on that.
Mate, that could be my first desk job.
It could be.
Mate, well, you're talking about the global energy transition, Dave. No, like Silverstone are at the bloody forefront of it. Mate, in terms of mining the critical minerals to get it, MMS are getting it out of the ground everywhere. For the bloody, have you seen, what do you think of the old MMS? This is actually a market-related question. These small mining companies that are actually doing these JV arrangements with mining services contractors to get up and going in a bit of a hybrid debt arrangement instead of going to a bank.
Well, I think it's good. Obviously, if you can't get your debt or your equity in another way, those kind of partnerships can work well. So more generally on mining services, we can invest in mining service companies. And I think one of the benefits of mining service companies is you kind of you step away from the commodity price, right? So it's really volume driven. So so when they come on,
Bloody Silverstone and MMS, we've already got your first investor for the IPO.
There we go.
Sorted.
Premier IPOs of 25.
Pleasure doing business for the desk. You beauty. Right, JD, you can bring it back to a more serious level if you'd like.
No, I love it, Matty. You won't be too busy on the desk because those ones will sell themselves. There are a couple other commodities we've got to talk about. So one in your top 5 holdings is Coronado, and I just want to start this going from a broader level. Met coal, what do you think in demand, supply, and then hone in on the half year, which we were chatting about before we started recording?
Yeah. So, I think a big change even over the last 12 months is a better understanding in the market of the difference between thermal coal and met coal, and met coal's role in steel production, and the fact that it's kind of a necessary commodity. So I think what you're seeing is from an investment perspective that it's becoming more acceptable, which is good. What you're not seeing though is a whole lot of money going into new projects. So it's that whole demand has actually stayed very strong. And I think will increase on the back of what's happening in India, which is an increasing buyer of Australian met coal, whereas supply is going to be constrained because it's very hard to get new mines permitted and approved, and old mines are starting to run off. So, and Australia has among the highest quality met coal mines in the world, right? So from the commodity level looks good. Coronado as a player in that, we also really like. It's probably had a bit of an up and down kind of history, but I think under the existing management team, particularly the second quarter result was really good at Curragh in Queensland, where I think you saw mining costs go from $125 a tonne down to about $95 a tonne, and they're pushing that down to in the 80s. And that's partly because they had a lot of material movement they had to do and sort of optimise the way the mine is being operated. But it's all very well to say you're going to do that, but then to actually deliver it and show the results. I think it's an EBITDA to enterprise value multiple of 3 times, something like that. So they get this right from a value perspective. It looks good, but also the commodity level looks good.
Was everyone starting to lose their patience a bit with Coronado? Like everyone was like, it's like a bit of a noted as that underperformer for the met coal.
Well,
it sounds like it's
I think
possibly turning around.
Yeah, well, exactly, and I think the market is still saying, well, that's a good first step, but let's see you follow through here. The other factor with Coronado is it was under takeover for sort of a rolling takeover for a period of time, and that's now sort of dropped off. But what it highlights, and I think we're seeing that more generally, is that there is demand for good quality met coal assets, and you've got a major shareholder in Coronado that is probably a seller. So, you've got the added kicker of something that looks cheap but with corporate opportunity.
And then another one I'm keen to chat about, rare earths. So Meteoric, I saw was a holding last time you reported your holdings, and that they've had a pretty tough few months of it. Not just them, but you look across the rare earths, and I think Lynas is the good one to tune into to get a feel for where this market is kind of at. But what are you sort of feeling on that side of things? Obviously, you're at the whims of China to a large extent. How do you sort of see that playing out?
Yeah, it's a good question, and it probably comes back to what we were talking about at the outset around observe, react rather than predict. And I think the view we got to, for most of this year was, rare earth NdPr prices were really low, and do we need to be here? And are we better off not trying to sort of predict that a turnaround might come, but wait until that turnaround happens and then re-enter? So we haven't been in Lynas for some time. We're looking at Meteoric, and we actually bought a small holding just about the time of the capital raise. And I think the Brazilian rare earth industry is fascinating because the potential to reduce the operating costs in the industry is significant. So it's I think it's one of those sectors where the commodity price is depressed. The negative is you got processing and you've got the raw material dominated by China, which is never a place you want to go to if you can avoid it. But rare earths are just so critical, and there's potential opportunity to buy the really good quality assets at a cheap price. So, Lynas will keep watching. Meteoric, we've got a small holding, and really interested to see what comes out of Brazil there.
Yeah, with Brazil, like everyone's talking about, like lowering the operating costs, but I assume is labour a lot cheaper over there?
Yeah,
it would be, because they talk about, like, obviously the hydropower's a lot cheaper.
Yeah,
but you think of, I wouldn't imagine, and correct me if I'm wrong, if a rare earth project, and even the lithium projects over there, like the spot, like lithium projects, they DMS only, they crush to 6 mil.
Yeah.
So you can't say they're going to use shitloads of power for crushing, and then rare earths probably wouldn't use shitloads of power compared to a gold processing plant grinding down to 75 micron. But I assume the labour is a critical bloody saving as well.
Well, I think you're right. And, I mean, and we'll probably talk on Pilbara and Latin, which is in Brazil as well. But what's attractive about that location is you've got cheap labour costs, you've got cheap hydro costs, you've got relatively rapid approvals process.
Which should lead to cheaper construction costs.
Exactly, construction costs are lower as well, right?
CapEx,
but just the nature of the of the ionic clays is the actual extraction process is much easier as well.
Because I think rare earth equities have sort of kept sliding, even though the NdPr price has stayed pretty flat. I think NdPr's gone up a bit, 43 to 47 last time.
Well, yeah, but even at $50, no one's really making money, right?
Nah.
So that's the issue. It's difficult. So
it doesn't matter if it goes up or down; you're just losing money either way. Or not mining.
And just on that as well, Dave, sort of mentioning Brazil more broadly, and Pilbara's foray into South America. There was a big article in the West about Dale singing his praises for Brazil. I mean, a big move, like a major like that. What do you think that, and particularly in light of what's been happening in Australia this week, as far as the whole permitting and approval sort of landscape? What do you think that that and the Pilbara's move sort of says about it all?
Yeah, look, I think it's a good deal for Pilbara. What they're doing is with very little dilution to their equity. They're adding a project that could potentially be, 450,000 tonnes of spodumene a year. But more importantly, if you take a view that spodumene prices might stay lower than where they think they should be, it's a project that's going to be, at the lower end of the cost curve, and it's for those reasons. It's low labour, it's low power cost, it's planning approvals, low capital costs. For a relatively small outlay, I think it's a good part of the portfolio. And there's been a lot of talk about them looking at something like Patriot in Canada, but and that's a fabulous project, but you're talking a whole lot of capex and maybe 5 to 10 years away. So it's just an easy bolt on for them, I think.
What about Sigma? Do you think that's going to be in the mix? It makes sense, obviously, but do you think Pilbara have bet on Brazil versus Quebec effectively?
I don't think so. I think it's opportunistic. I think they want to. Obviously, they want to have an exposure there. Whether they want to double up and buy Sigma, I'm not sure. So I wouldn't bank on that. But time will tell.
Yeah, and that's the thing. For the amount of 6.8% shares they issued, they could just sit there for a while. Yeah. But they've got it.
Yeah, exactly.
And they've got the optionality.
Yeah, exactly.
Oh, ding on Pilbara as well. Sorry.
You like a bloody ETF.
The GC ETF.
A bit closer to home, Dave. What are you thinking of Liontown? I noticed. I think yesterday morning a bit of an interesting line went through of stock I think in the morning there was a decent amount of stock change in hands. How are you kind of thinking trading?
How much was it,
80
JB?
cents? There was, I think, 50 million shares, which is, they're a bit under $1. So not a crazy amount, but above average.
Yeah, look, I think you've got to give the management team there a lot of credit for what they've delivered over the last year, right? In a difficult market, they've basically got to the point they are now on cost and on budget, and they've put some funding away, right? So I think that's really good. But I think what we all know is that commissioning a lithium project is bloody difficult, and it's going to take longer, and it's probably going to cost more than you'd want. And then on top of that, you got a spodumene price at $800 a ton, right? So my view is, I give them credit for what they've achieved so far, but do I need to own it right now? I don't. So I'll watch it through that process. I think if you say, where's this business going to be in 5 years' time, I think it'll be there, it'll be producing, it'll be a fantastic asset. But I think probably now's a bit too early to jump in.
Yeah, I think. What is old Miss Reinhardt up to? That's that's and I think we talked about like the control she's got on that now. No one else is going to have a crack at it. Yeah, bloody look what happened to. Oh, it probably saved Albemarle. Imagine if Albemarle. Yeah, it got it through. Yeah. Like, and I'm sure, like if you go back in history, imagine if like Liontown. Entertained the original Albemarle deals that were like $1.80. Imagine if that actually got over the line. Yeah. Wow. I reckon at the time they were thinking, worth more than that, but they would never have envisaged this was going to happen to them just because of the mania. But it's just turned so quick, and they've just gone through the whole greenfields process straight into a shit pricing market. So. Yes, I bloody do feel for them, that's for sure. Yeah, no, it's you're exactly right. Hindsight's a wonderful thing.
Oh. It sure is. Dave, I reckon I'd like to close off with a couple of lessons from the last year, and I reckon we should do another overrated, underrated segment as well. So what do you feel in the last year, some lessons you've learned, commodity or equity related?
Well, things can change really quickly, right? So you look at lithium. What it shows is predicting what's going to happen is difficult. So, I look at lithium, and when it was $400 a ton, 2020, no one thought it was going to 8,000 spodumene, and then no one thought it was going from 8,000 back to 800. So I think that's number one. I think probably the second point is resource sector investing is all about quality ore bodies, right? So it's mitigating risk and buying good quality stuff that will survive and as an investor see you through good and bad markets. Yeah. Unless you're Capricorn and you can make a 0.8, 0.9 gram.
Well, the exceptions to the rule.
Money, anyway, as they've been touted, the unicorn.
Yeah.
Another one on the sort of rapid fire random question round. I'm keen to know, Dave, what's the commodity that kind of intrigues you most, or the market that you think there's the most to kind of learn about and get excited about?
Yeah, it's a good question, but I tend to focus on the bigger commodities. So I think copper is really interesting just because of the impact it has on the global economy and its importance to the global economy, and it's hard to see how demand won't keep increasing and supply will be constrained. I think met coal's kind of interesting as well. Gold is probably one which is harder to clarify, where demand comes from and where the buying comes from, and how the market kind of prices it. So they're probably a few.
Because how do you analyze gold? Yeah, because it's not a supply demand thing.
To me, there's three buckets, right, which drive gold. First is sort of the retail demand from primarily coming out of China and India, which is for jewelry and as a store of wealth, really. But it's really jewelry, and that market has been very steady for a long period of time. Good buying out of places like China, where the public is saying, I wouldn't mind having some of my wealth in gold jewelry just because it helps me keep control of it. and that's been stable. What you're seeing more recently is as gold price goes up, demand is actually coming down because it costs more to buy, right? But in general, that's a stable market. The next bucket is central bank buying. And if you look at what's happened over the last 2 years, what has driven the gold price has been a surge in central bank buying, particularly from China, but also from those global economies that don't necessarily want to hold US dollars or US dollar assets. So it's places like Turkey and Uzbekistan and Russia and stuff. And so that's really driven the price up to date. What we're seeing now, and then the third bucket is the investor ETF market. And really for the last 3 years, there's been net outflows on a month-by-month basis. It's taken a spike when COVID happened, and it took a spike when we had a banking crisis, inverted commas, in the US, which lasted a month or something. But apart from that, outflows had been pretty steady going forward. What you saw in the last 6 months is you started to see some inflows from a lot of European markets, but not from the US. And really only in the last month is you've seen the US investor come into the ETF market. So what that says to me is there's increasing investor demand, more broad-based for gold, and that's corresponded with the price ticking up.
What's the relative sizes of those buckets, would you say, in terms of your weighting?
Yeah. So the big one would be, I think they're all pretty big. The ETF side is probably the smallest, but also the most variable on a month-by-month basis.
But I'm going to put that down as the most interesting thing I've heard all year in terms of learnings about how the best explain the gold market.
Oh, that'll be a great
show. You can get a free T-shirt, Dave. All right, that was sensational. Appreciate that.
And I reckon that opens up the perfect first overrated or underrated question, actually. So it's not your first rodeo, Dave. So overrated, underrated, or neutral. So Aussie dollar gold over $4,000 an ounce in a year.
Fucking not far away.
No, it's not.
Less than 10%.
So underrated?
Underrated.
Yeah.
Okay.
How about iron ore? Does it hold under US 100 in 1 year's time?
No. So I don't know how I translate to underrated or overrated, but I think it'll be around $100 in 12 months' time. Yeah.
We'll go neutral then.
Yeah.
Neutral.
Yeah.
Do you reckon the ASX resource index is higher or lower than where it currently is in 1 year's time?
It'll be higher.
Small cap gold, Australia.
I think you got to be. I think it's underrated. So I think it's hard to see that disconnect in value between the big and the smalls can continue. So if the gold price maintains anywhere near where it is now, I think you'll see money flowing.
Well, part two of that small cap gold M&A, either between themselves or from bigger from big caps.
Absolutely. So underrated. And I think there's a recognition that needs to happen, and it's obviously easier than developing something from scratch. So I think it's underrated.
But Brightstar might just merge with every company instead of the next 5 years.
Right. Yeah.
Some good deal flow. Brazil or Minas Gerais as a jurisdiction.
Look, I think it's fairly rated. I like Brazil for the reasons we've talked about, but I don't think you can classify as a tier 1 location, right? It's still not without risk. Yeah.
How about Argentina? We've seen a bit of action there. Do you think that's, the risk is overrated or underrated?
I think it's probably underrated, but again, there is still risk there. And I think the risk has come back. I think the new government there is outlining a plan that's more supportive of mining, but things can change, right? So there's no lifetime guarantees in places like that. Yeah.
Permitting and approvals risk.
I think it's underrated, and I think it's going to be discussed more in the next year. If you looked at one theme that's going to play out over the next 12 months in Australia, in particular, I think it's going to be that.
One we actually haven't covered at all yet, nickel.
Yeah, it's tough. It's tough. So I think we're all aware of the story. Increasing production out of Indonesia. I think the project to keep an eye on there is the Centaurus project again in Brazil. I think they've done a great job there. If there's one nickel sulfide project that should get off the ground, it's that. It still should make reasonable money at current levels, and I think there will be demand for it. So I think it'll be fascinating to see how that rolls out over the next year, and whether they can get a party to come in at the asset level and really get that happening.
Is there anything on have you looked at like the spacing between nickel booms in history? Like, is there, we've just, it's low, but it can obviously stay low for a while, and then it's very obviously boom bust. Yeah. But
yeah, I mean, the expansion in production out of Indonesia is, from a historical perspective, the volume growth is substantial. Now, I think demand is also increasing, reasonably rapidly as well. But there's a lot of uncertainties there. So,
GC ETF is a ding on Centaurus.
Do you think Metals X, the company, is underrated or overrated?
I got to do the ding because we actually own it in the fund. So I think it's underrated. Capped at 380 mil, 180 million cash. Tin prices current level, it's making probably free cash 25 a quarter, so 100 million a year. Still got a $36 million convertible note with Cyprium. So some of the parts, it looks good.
Cyprium, what'd they do? Offtake with Glencore recently?
Yeah, well, I think there was something today. I didn't see the detail.
I haven't seen the one today.
Yeah.
I think we're all out.
All right.
Bloody sensational, Dave.
awesome.
Mate, anything you want to talk about specifically? Anything you want to bring to the table?
I think I'm all talked out, but keep doing what you're doing. It's good to have a voice in the industry that's out there every day, keeping people informed of what's going on. So well done.
We're having fun.
Oh, cheers,
Yeah, bloody good fun.
Yeah.
Awesome.
It's like driving back from Cal from Diggers. In the car with JD and GC talking stocks.
Yeah.
Like, what a day.
Yeah.
What a day
7
job.
hours of it.
Didn't even need Guns N' Roses on the music to keep me awake or anything. Right, good on you, Dave. Appreciate your time as always,
Thanks
mate.
a
We're
lot,
going to have you back in end of the month doing a bit of a special with...
Looking forward to it.
Oh, God. Bloody how much free... Jimmy, send me some royalties when you're frigging again, mate. Right, thanks to all the bloody, speaking of royalties, bloody Axis Mining Technology, flicking us some royalties every now and then. And the potential IPOs we talked about, MMS and Silverstone. Apologies if you get inbound calls about those IPOs.
For seed,
MMS and Silverstone. Who else we got? VRIFY, SMEC Power Technology, DSI Underground, CR Insurance, Greenlands Equipment, K-Drill. Get a spark chart up here as well. Hoodaroo, Money Miners.
Hoodaroo. Thanks, Dave.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.